Evening, everybody. Welcome to the last session on market making for bonds in India. Will it succeed this time? So we have a distinguished panel of speakers. I will introduce the moderator, Dr. Poonam Tandon. Dr. Poonam Tandon is one of the earliest members of India First Life Insurance. She heads the investment management function at India First Life Insurance. She has 26 years of experience in financial services sector. She has served at MetLife India Insurance, at Paternoster LLC, a London-based startup pension fund, Securities Trading Corporation of India, and IDBI, where she started her career in 1994. She's a BCom honors graduate from Jesus and Mary College in New Delhi. Poonam is an alumnus of XLRA Jamshedpur with a postgraduate diploma in business management. She has earned a PhD in financial management from NMIMS, Mumbai. Good evening, Mr. Poonam Tandon. We welcome you to the third session on market making for bonds in India. Over to you.
Good evening, everyone, and thank you so much for introducing me. Today we have very distinguished speakers on our panel who will be sharing their views and experiences about the markets and their market making experiences. So let me introduce you to Shamik Ray. Shamik is the head debt capital markets at ICICI Securities primary dealership, which is also known as ISEC-PD, a leading primary dealer and market player actively trading in government securities, corporate bonds and overnight index swaps, and raising debt for its corporate client team. So Shamik heads a team of debt investment bankers who works with their corporate clients, advising and executing debt raising and investing in Indian capital markets. So Shamik has 24 years of experience in fixed income markets. The other speaker that we have today is, panelist that we have today is Manish Kotwani. Manish is a senior investment banker with a focus on fixed income space, and he is currently exclusively associated with Mahuka Capital Advisors for debt raising and is also advising a leading private equity house. Manish has 17 years of experience in fixed income space and has worked with institutions like HDFC Bank, IDFC Bank, ICICI Bank, and Talit Prebon. He has concluded marquee transactions across multiple sectors and has leadership experience across an entire spectrum of investments from origination, bond sales, and loan syndications. So welcome both of you, Shamik and Manish. And I hope this, of course, we are going to speak on market making. Now, market making in bond markets is really, on corporate bond markets is really, really important because these markets are very illiquid. And this is the discussion is going to be on this, and these two are really, really experienced market players, and let's hear it from them. So Shamik, shall I first ask you this? That what are the essentials that a market maker should look for in a business model? Since you have been in ISEC-PD, and ISEC-PD has been for almost 3 decades as a market maker and a primary dealer. So this question goes out to you.
Yeah, thanks, Poonam. Thanks for the introduction, and hi to the audience for being patient and still logged in on a Saturday evening. Corporate bonds per se are very critical because we need an alternative to a bank-run economy, and we don't want to be something like what happened to Abhimanyu, that you invest, like Abhimanyu went into the Chakravyuh and could not get out. So that's why we need liquidity, that you invest and later you want to exit and you want to find liquidity and you don't get it. So that's why we need market making. And coming back to Poonam's question, what would a market maker look at? So the interesting part is that traders can give two-way quotes in the market and buy and sell and try to make money on their what in stock exchange parlance is called jobbing. When you're going to do that informally and you do it on your own terms, and when you find the market good, so you would feel that when the interest rates are going up, you would not do it. You would sell your portfolio and stay out. You would feel when overnight rates are expensive and your short-term borrowing is expensive, you would stay out. So if you're going to have a compulsory requirement to do this, then you would want some extra income to protect you from, let's say, your portfolio going into loss or your funding coming at a higher cost than your investment. So I think the market maker will look to make fees from the issuer. He would like to have some kind of hedging to offset the risk on his corporate bond portfolio. And he would look to maybe trade in and trade out and make some possible trading gains.
Yeah, so it also, I mean, it is a slightly complex, system that the market maker needs to survive, through this. It's a very thin margins, and in case of an devolvement and all, it becomes pretty capital intensive because he needs to borrow also. So yeah, it is at times it could be quite a strain, because if we find that the fees is not enough and there's a market depreciation, it can be quite a challenge. So Manish, over to you. What are the current trends in the corporate bond market in terms of liquidity?
So thanks, Dr. Poonam, for the introduction, first of all, and thank you, CFA Society, for this opportunity. Coming to Poonam, your question, I personally feel, based on at least what the numbers are depicting, the volumes in corporate bond don't seem to be low when you typically end up comparing it with government bond markets. And I'm saying this basis the fact that, on an average, daily volume is about 7,500 to 8,000 crores of corporate bonds. When you look at GSEC, which is what we end up comparing it with, it's about 30,000 crores a day. Now, if we look at these two numbers in proportion to the outstanding government bonds and outstanding corporate bonds, the ratio of corporate bond turnover is not that bad. I mean, just to throw a number, 78 lakh crores of GSEC outstanding, leading to 30,000 crores of daily volume. And this is, we are talking about a single issuer who is a sovereign entity. While on the other side, we are talking about, more than 3,000 plus issuers across rating curves. And they have, about 8,000 crores of volume, which is about 0.22% of the turnover, while GSEC is about 0.38% of the total outstanding turnover. It's not a bad number, I personally feel. Also, when we look at the annual numbers which are available in the public domain, this number has been growing on an annualized basis at about 8 to 9% CAGR. Now, one would say, still that there is opportunity for these numbers to grow, no doubt about that. And, there have been few incidences in the last 2 to 3 years, because of which the numbers have slightly dipped or, have remained flattened in a year or so. But in general, I think the volumes are pretty okay when we end up comparing it with the govies.
Yeah, that's a very good way of looking at it, because we always feel that corporate bond markets are very liquid as compared to GSEC. But if you look at it from this angle, Manish, it's a very laudable thing actually. That they are almost there, and so it's not so bad. I mean, Shamik, you and I have seen way back 24, 25 years back, we used to do one corporate deal a week, It used to take that much time for one deal to fructify actually. So post the DMAT and all, things have improved so much, so that today we can still say that it is fairly liquid, like how Manish has come out with this analysis.
Yes.
So Shamik, how do you manage the risk associated with market making, especially in a rising interest rate scenario?
I think that is the crux of the situation, that how do you manage the risk? But first, before we go to the interest rate risk, I would just like to mention the credit risk first, that if I or any entity, I'm speaking on behalf of not necessarily my company, these are all personal views. I'm speaking on behalf of how markets would look at it. The first and foremost, I think, issue is that, do you trust the credit well enough to give it a commitment over the next 6 months or 1 year, or as the SEBI has asked in the position paper, for up to 5 years. So the first and foremost is that you do not want a downgrade in the next 3 months or 6 months or even sometimes rating agencies will change the outlook from stable to negative, which signals a possible downgrade in the next 15 to 18 months. You want a credit safety. Second, and this might sound a bit paradoxical, but this is plain common sense. A market maker would require a certain minimum liquidity to look at making markets. So like if you want to reach a, let's say, a stage of say 60 out of 100, because beyond that possibly it is impossible, and we are currently at 0, the market maker would say that I'm the catalyst, I'm trying to improve it, but I can't have a lift off from 0. So maybe if the bond is already liquid as a strong PSU or a strong HFC or an NBFC or some other similar very strong credit, the market maker would say that if it is already at 30, then let me try to take it towards 50 or 60. And of course, the other point you mentioned, Poonam, that you need to take, I'm sorry, am I audible? There were some interruptions.
Yes.
Okay, thank you, I'll continue. The other point, as you mentioned, is the interest rate risk. So when rates are going down and I have inventory with me, I am gaining. But if rates are going up and I have inventory with me, I'm losing out. Also, when rates are going up, possibly I don't have too many buyers, but I have a lot of sellers queuing up to try to hit me on my two-way quote. So can I hedge using interest rate futures? Unfortunately, interest rate futures, while matching on the durations, do not have much liquidity. Can I hedge on the OIS? I think partially yes, but OIS has a basis risk that OIS is used by global sovereign funds to sort of take macro trades across Asia, across India and other emerging economies. So maybe on the hedging part, if I cannot hedge at a time of rising rates, the only option is to curtail the market making, to bring down the book towards 0 and set out and come back again at a more favorable time when the rates are steady. So you might say that the market maker would be of the most utility to investors at the time of the most volatile markets. But paradoxically, I think his utility will be when markets are stable, to improve the liquidity and not to give the liquidity when the markets are most unstable.
I agree with you, Shamik, because I remember in SCCI that used to be a real, problem or a real challenge rather, that, I mean, the survival of the market maker is in question, right? In that kind of scenario. So, yeah. Now over to Manish. Manish, how much inventory would you keep, and what is the deficiency period if you are a market maker?
So, Poonam, I think there is no exact answer to this. It depends on a lot of factors. For example, if I am doing a market making in a PSU paper or a AAA housing finance company, then on a 2,000 crore outstanding ISIN, one can do market making with just 100-200 crores of that particular paper, and that's good enough in my opinion. Also, if you look at, say, a AA rated or a AA plus rated corporate bond, the issuer might have issued, say, about 300 to 500 crores. And again, a 100 crore number or a 150 crore number in that particular paper would be good enough to do the market making or to quote a two-way. And market participants would be happy to see a two-way in that kind of a number, in my opinion. In terms of the period, as Shamik also earlier said, see, typically any bond post-issuance settles with the end investors maybe in about 6 to 9 months of time. So, to quote a two-way for beyond 3 months or 6 months might not be pretty relevant as well. Plus also the fact that, I have my doubts if, underwriters and merchant bankers are going to have separate limits for market making. So it will have to be a carve out of their existing books itself. So in a way, you're taking more risk, you're blocking your underwriting capacity to that extent, because now part of your book you've devoted to this entire market making process. So from that perspective, a 3 to 6 months period, I think, is good enough.
Okay. Yeah, I think that should suffice. Otherwise, it kind of becomes stale and newer issuances come in, and so you will not have place also in your
Yeah, I mean, because there are so many corporate issuers, unlike, GSEC, where it's one single party
issuer,
the paper, you need to be fair to across the market to deepen the for all the issuers.
Yeah, I mean, and maybe possibly there could be larger issues so that, more people are involved in it. Suppose, I mean, how would you look at it, Manish, if you say market making is mostly in the liquid securities, or the securities become liquid due to market making? So what would you answer? Yeah, how would you look at this?
So I think it works both ways. It depends on the rating and the tenor of the paper. If the paper is AAA rated, it is a PSU. I think the paper is already pretty liquid and is being quoted in the OTC market any which ways. Now, I can increase the volume over there by quoting two ways and being a market maker. That's one way to look at it. Two is when I go down the curve from AAA, say to a AA plus or AA, and these I'm talking about the non-HFC, non-NBFC papers, which you would not hear on a day-to-day basis being quoted. Now over there, if one starts quoting two-way, then that is something that you're creating from the scratch. It will obviously take some time for this to develop and kind of deepen. But slowly, I think the need is that we focus from AAA maybe up to the AA market to start with, and go beyond PSUs, HFCs, and NBFCs, and that could be maybe the first order.
Shamik, would you like to add something to this?
I think that we have to step back a bit and also look at what is happening from the corporate bond overall from the regulator side, that we started with unlimited ISINs and it was brought down to 12 ISINs per year. Or I think that, we are talking too much jargon here. Basically, we are saying that a corporate cannot have more than 12 maturities any 1 year.
Yes.
That was to encourage the corporate to not fragment the issuance, to have too many different maturities and with very low floating stock on each. Currently, there has been a proposal from SEBI to bring that further down to 6 per year, 6 maturities. Now, unfortunately, we can't have a cake and eat it too. If we have only 6 maturities, we have far more liquidity, but the refinancing risk is higher for the corporates. So I think SEBI and the market has been talking to each other, and we will await whether there's any final decision on that. We also have the Repo Clearing Corporation and the buyer of last resort. So I think that what I'm trying to sort of conclude here is that market making is not the only way to improve the markets. It's one of the way to improving markets, and there's a whole set of things being done. This is a very important part of it, one of the most important parts, but it's only one of the parts. Hopefully all these things gel together and we get a better functioning corporate bond market.
Yeah, I agree with you as well. Shamik, also, what are the measures of market making activity? I mean, how will you say that, that market making is, you have successfully done market making? Is it the bid offer spread, or is it the liquidity in the markets for that particular volumes? What is it?
Well, I think that the SEBI paper has mentioned a few measures which broadly, I think, look okay. When I'm saying look okay, we have not done market making so far formally in this country. It has not been done, I think, in most jurisdictions abroad. So therefore, we are sort of feeling the way. And as I think Governor Subbarao mentioned, you don't, you feel your way across the river by stepping on the stones one by one. So maybe the measures which are mentioned in the SEBI paper, one of this is that how many trades does a market maker do out of the total trades in a day? Of course, it will also depend on what amount he's quoting for and how many such trades are there, not very large trades or very small trades. How much part of the day the quotes are available, how regularly it is there, especially in stable markets. And maybe how, if it is possible to find out, it would be a great exercise for some research people to do, maybe some professors and specializing in finance working in this market, that after a market maker started, how much of the increased liquidity was because of the market maker and how much was because of other factors like, say, rates falling or issuance increasing or investors having more money to invest. But somewhere I think we have to find this as we go along. So your question is right, Poonam, that to go somewhere, we have to find out what we want. But right today, we are not very sure what exactly is what we want. But yes, we have to identify it and then take it forward.
Yeah, possibly maybe once we start it, we'll have an idea, and as we go along, maybe we can start finding where all we need to, improve or what needs to be done extra or not done, possibly.
Right.
Manish, why do liquid securities lead to more market making?
So basically, see, if the security is liquid as a market maker, obviously it gives me a lot of comfort that in a rising interest rate scenario, I'm sitting on a liquid security, which I can churn my portfolio easily with. Also, in a rising interest rate scenario, it would be easy to curtail the losses of the market maker, which is obviously very necessary in this kind of a situation. As Samik also mentioned, in terms of interest rate futures, etc., have not yet developed in the country, and it is very difficult from that perspective because these rates, I mean, historically we've seen they don't even move in tandem from that perspective. So it is very essential that a market maker needs to have a profitable strategy, and from that perspective, I think it would be necessary that it happens in the liquid segment to start with.
Yeah, I agree. So at least there will be some liquidity from the market maker's side and also for the markets, rather than absolutely shutting down. Agree totally.
Yeah.
So so Manish, how can the volumes on the RFQ platform be increased? RFQ, as most of you would be knowing, is the BSE and NSE is giving a screen-based corporate bond market, and there is a need to increase that trading. It is kind of replicating the NDS home, idea of the GSEC screen-based trading platform. So how can we increase this?
So to start with, regulators themselves have been any which ways tightening the screws. They have been increasing the percentage for the investors in terms of what amount of volume or percentage of volume they need to do through the RFQ window. The earlier was 10%, now it's about 25%. And even other regulators need to align to that extent, whether it is IRDA, PFRDA, so on and so forth. So that's the way, eventually you will be bringing in more volume per se on the screen. Also, see, since we are talking about corporate bonds over here, unlike GSEC, standardization of terms is very, very important. Today, if we compare any two term sheets in the corporate bond market, they are not apple to apple. They are like pretty starkly different, especially when you go across the rating curve. Also the fact that my personal opinion on this has been that we end up comparing this entire corporate bond segment to GSEC for some reason. However, I think a broker over here can play a very, very valuable role. And like the equity markets, if you make compulsory that you trade through the broker market, the broker is the one who is kind of bringing in information. So I mean, if we were to look at it as a replica of the equity market rather than comparing it with the GSEC market, it would be very different in my opinion. Also, RFQ is obviously still a very new platform. When we look at RBI NDS Home, it has been there for 15-16 years. The entire user experience itself is very different. Plus at the same time, at the cost of repetition, we are talking about one issuer versus corporate bonds which are spread across 3,500 issuers across the rating curve. So it's very different. I think it will take some time. There is certain push needed, and these markets are totally different in my opinion when we talk about GSEC versus corporate bond. So I personally feel there is no sense in comparing both of them, literally like apples to apples. They both need to obviously develop further and deepen further.
Yeah, actually I agree with you, because what happens is that it's not really, as you say, there are different, corporate bonds are a different animal, and each corporate bond is again, A and B and C are also not comparable. So they'll have different, maybe the pricing is different. They could be, discounted, or they could be a zero coupon or whatever, what have you. So each one is different. They could have been actual by actual, or this convention, that whatever. So an issuer wise, rating wise. So we cannot, put everybody in the same basket. So I agree with you totally on this. And sometimes even the, information is not, the screen may not be able to give you full information for that particular corporate bond, because maybe that it's not a standardized one.
Yeah.
So,
Poonam, if I can just add to what even Manisha is saying.
Yeah.
So the world over, the corporate bond has been an OTC market by definition, because of various factors like so many issuers, so many bonds. The problem of a fragmented bond market is there overseas also. The interesting part is that even then, the volume of trading of corporate bonds on the screens has been increasing in the last couple of years. Possibly what I read, because I try to follow this, is this has happened because of COVID and work from home. Where teams who normally work in office and coordinate best are now learning how to coordinate over
the screen,
other channels over the screen, and hence screen trading has gone up. But having said that, I do understand what Manish is trying to say, that how do you try to get a broker to play a role? So I think this debate will continue, that whether we have a direct screen-based trading or we have a OTC trading with the brokers, and we'll have to see where we go from here.
Yeah, I think yes, maybe it is a combination of both, and maybe the ones which are more liquid, maybe traded more on the screen, because maybe like large issuers like NABARD and like the PFCs and RECs, which keep coming time and again with the same type of coupons and whatever at their own issuance. So people understand that, while the others may not be that, and maybe that might be more broker driven. Possibly it will be a combination. Maybe we'll have to figure it out as we go along. So yes. So Shamik, since you've been there for so many years, you would be having so many special experiences about market making. Any trends or insights over the period? Any experiences, interesting experiences which you would like to share with the participants?
Well, I think the first thing I would like to mention is that almost no institution in the market has been comfortable with market making. So it has not happened so far, except maybe a couple of cases which I recall, and maybe there won't be too many others, because we do try to follow all of what is happening in the market. So the first time it happened was around 1996. We had this entity called Shipping Corporation of India Limited, which was later shortened to SCICI, and which later merged into ICICI. At that time, ICICI Securities had tried to do an innovation in the market, that we told investors that please come and buy this bond, because you will get assured liquidity from the market maker. The bond was a treasury bill with a spread. So in some ways, all the treasury bill floaters we are seeing mutual funds buying today, the similar principles were there, though our market was in baby steps at that time. In 1996, we had a treasury bill floater plus a spread being issued by SCICI. Unfortunately, at that time, Reserve Bank used to do monetization, and when the interest rates went up between the government and the Reserve Bank, they decided not to raise the coupon on the treasury bills. So the treasury bill cutoffs used to come 1 to 2% below the market levels. And because the rates were not good enough for the investors on the floater, there was no reset to a higher level. The investors came and sold to the market maker till there was no floating stock left in the market. The entire stock was with ICICI Securities. And then we went to SCICI and said that, look here, we thought we would carry out of a 500 crore issue at any time 50 crores or 100 crores and do our market making. But we have been dumped 500 crores of this stock, and it's not possible for us to run this kind of positions. So SCICI was very supportive and they bought the entire 500 crores back from us. So that's the first and the last time I recall that market making happened in private placements. And the takeaway is that the market maker can help the markets, but he can't go against the markets if the entire market decides to come and sell to him. So there has to be a way, formal way. What happened informally, because the arranger, the market maker, and the issuer were in sync with each other, and they were able to help each other. But in future, if you try to implement this process, there has to be a formal process that in case an amount beyond a predefined amount comes to the market maker will be able to go and sell it back to the issuer. The problem here comes in that the issuer has raised money in good times, and in bad times, he is having to buy back his bonds when actually he's on the borrowing side. So this is a somewhat unusual problem if it comes up, that the issuer will say, I'm there to help liquidity in the market, but I'm not there to buy back my bonds at the worst of times and actually on the borrowing side. The other case, and this is also equally interesting, though it might seem less important to those of us who are in the institutional market. We had a public issue of Shriram Transport, where one of the arrangers, Kotak Bank and Shriram Transport, they took permission from SEBI and they brought out a system where up to 2 crores a day would be traded by the market maker, and the market maker would give investors ticket size of 1 lakh, 5 lakhs, 10 lakhs, and only smaller amounts, an opportunity to buy or an opportunity to sell. I think this is very important, that as the importance of the debt market is going up, we have to find out why this has not been done in future, but in subsequent public issues. We have to see how this can happen in future. And if we are getting small investors in for 5 lakh or 10 lakh ticket sizes who are able to go and sell on the screen, it might help bring NCDs to the retail public, because they will be assured that at a price they will get liquidity.
Yeah, but that only, as you said, Shamik, for the liquid, for the retail participants, it is good. But I don't think for the institutional, you can have, otherwise the market maker, like you said, if a tsunami comes, market maker will be washed out totally. Like what happened in the shipping corporation case. But but otherwise, SCICI case. But what happens normal, maybe the retail investor, yes, I think is a good thing, especially with the GSEC retailing happening. That way, a corporate bond market could also be developed on a retail side. Then yes, that market making role really has some value add which he's doing, because the institutional investor is anyways is informed and knows. I mean, you can't dump everything on the market maker. He will have nowhere to go. So yeah, I mean, that is a learning from there, Shamik. I mean, I don't think we have the right answers, but yeah, I mean, that is a learning. That's it. So Manish, how has the experience been between say GSEC and versus corporate bonds?
So Poonam, in terms of market making, I believe RBI has tried in the past pushing the agenda of market making. Unfortunately, they have not succeeded, in my opinion. Even today, only the top 5 ISINs out of the 100 outstanding ISINs in the GSEC market is where one sees liquidity, right? And this is, when we compare this with corporate bonds, as I said, we have today almost 27,000 plus ISINs outstanding. So very difficult to compare between the two. Also, the fact that we have created in a way a perpetual demand for GSEC or SLR by banks, insurance companies, provident funds, pension funds, because their regulators have put a minimum number that one needs to invest into as a limit into GSEC, which is the minimum limit. When you do a comparison of this with corporate bonds, there is no such minimum limit. Whatever is left, it's up to you whether you want to put that into GSEC or corporate bond. Insurance companies obviously have some limits guided by IRDA to put in infra bonds. But, unless there is a push that, you have to invest into corporate bonds, the volumes per se or the market making would not increase. I mean, just imagine if banks don't have this condition of minimum 19%, 20% SLR, why would they, quote two ways, or why would they trade to that extent? So as again, this is my personal opinion, obviously, but, I find this comparison between GSEC and corporate bonds, slightly futile because they are moving in a very, very different state, both of them.
Yeah, I agree. They are apples to oranges, so it will be different. But the government securities, if you see the market right from say 90, 93, whatever, when it kind of liberalized and all that, you see that the volumes have increased. Of course, there are, because we have had DVP2, DVP3 and all that. So yes, so on the screen, you've seen the market, the volumes increasing. Of course, I agree with you that there are 5 securities which are most liquid, but then they are the ones which are there with the traders. Rest, as you know, goes to the investor. But yes, they have become far, far more liquid than what it used to be 25 years back. Even GSEC, right, Shamik? I mean, if you remember those days when it used to be hardly any volume, and then it was an OTC, and maybe because of the screen and the DVP and other and the netting and all that has come over time, technology changes and stuff like that, the volumes have increased. Yeah, you cannot compare the two, but but yes, volumes have increased in the government security side, for whatever be the reasons. One thing is that it is sovereign, so that gives a lot of comfort, right? So, which the corporate doesn't give, and especially not after the 2018 crisis that we've had in the corporate bond markets. That has kind of regressed us so many years back. So, yes, that is a...
So Poonam, if I can just add to the points.
Yeah.
One of the competitors for market making and secondary liquidity is again an interest. I'm sorry, am I audible? Yeah.
Now you are. Yeah.
One of the problems with secondary market trading and secondary market liquidity is the competition from primary markets. So the interesting part about our GSEC market is that because of the recent problems during COVID, where the government had to borrow more, and even before COVID, we are a growing economy. Our government is running large deficits to increase the growth of the economy by pumping in more resources. So the enormous amount of primary borrowing means that investors have options every week to buy in the primary auction. As a result, the need for the investor to buy in the secondary is somewhat less. So market making would function when you have fewer issuances and you have gaps in between, so that there are investors actively looking to buy, as well as a market maker looking to sell.
Correct, Shamik, I agree. I agree with you. I remember those days when we used to have auctions every fortnight. Now we have it every week. Not every week, we have it every second day. Every day we have, right? We have Tuesday, we have SGL, Wednesday we have got T-bills, Friday we have got GSEC. So there is no time to digest it also. So
the other interesting part is that what certain large banks and primary dealers and institutions do in corporate bonds is that when they arrange a bond, or when they take a large position in a bond, they look to sell it down thereafter. So in some ways, this is sort of taking some inventory on the books and retailing it down.
Right.
So this again, we have somewhat diverged from what we used to do when issuances were less, when maybe the borrowers' balance sheets were less, when we would run positions and actually actively buy and sell. Now it is a large institution. It could be an insurance company. It could be a mutual fund. It could be a primary dealer. And of course, it could be a bank. They're taking on the books and they're selling down.
So
while we give, so while we give liquidity to the markets, we are actually on the sell side. We are not on both sides, on the sell or the buy side. Or if we need to support markets to ensure that we sell, we do some limited buying. So this also is a sort of a challenge for us, that how do we get both the buying and the selling to exist instead of just the one-way selling.
Yeah, maybe it is a, the kind of market that we are in, with interest rates being at the lowest. So you are just on that side of the market where you would like to sell and clear up your books to buy more. So possibly that is the reason why that you wouldn't like to buy. So you are just like taking it and then passing it on to the investors. So yeah, I mean, maybe it's your interest rate view and the interest rate trends. That
if I can make one more point, Poonam.
Yeah.
Somehow, for whatever reasons, we have seen that certain very large institutions have become very conservative and they are buying only in primary. So again, when investors themselves are not buying in secondary, they themselves are making the markets illiquid.
Right.
And any other entity which is trying to both buy and sell in secondary markets should get some support from investors. So maybe we could have regulators saying that a certain part of their regulated institutions buying in corporate bonds should be from secondary markets, so that the markets become a bit more liquid, and then the market maker has a better chance of finding buyers or sellers.
Yeah, maybe yes, we could consider something like that. So now again Manish, what changes would you require from the policymakers with respect to market making? Shamik has given one or two suggestions. What would you like to say?
So, Poonam, as I said, clearly to start with, the ratings are going to play a very critical role over here. It's not that overnight the market is going to, start quoting two ways across the rating curve. So, a AAA going up to AA, where we see the maximum liquidity, because even regulatorily, a lot of investors are, allowed to buy AA and above rated bonds. So that's one way. The other thing is, and I know it's a tall order ask, but at the same time, it's a tall order ask from the regulator also to, for market making. If we look at the period of LTRO, RBI came out with this solution of, giving a leeway on the MTM that the banks were buying, while on the other side, mutual funds were selling. And, for the first time, I saw banks opening their purse all the way up to AA minus credit. And this was not because, the regulator was giving them liquidities through the LTRO window. It was mainly because of the fact that they wanted to increase their balance sheets. But at the same time, they knew that there is no MTM risk on this paper. So if I have to run or do market making for, say, top 100, 200 issuers, and I know I don't have to carry a MTM, eventually, if I sell at a loss, obviously it's a absolute loss. But, if I'm not worried about the MTM, that gives the market maker slightly more deeper pockets, or gives more comfort to start quoting these two ways. But as I said, one might say this is a tall order ask, but at the same time, DCM houses don't have, or underwriters don't have surplus liquidity. And, roughly about 10 to 25% is where I see these guys devoting their balance sheet of their total underwriting books for market making. Currently, the paper that has come out is talking about 25% of the total issuances needs to be, taken by the market makers. We have 7 lakh crores of corporate bonds getting issued every year. 25% of that, definitely, if we put all underwriter books together also, we would not have that kind of
money.
Yeah. Also, in terms of, the papers that will need market making are slightly selective. So even if it's a AAA rated infra company or a one-time SPV of a road project or a transmission project, there is no need for market making for those issuers, right? They have issued once, the stock has gone to the end investors. So clearly, the first focus should be to, kind of have market making in the top 200 or 400 ISINs at best, make that world a slightly more liquid, which would get sufficed by the AAA to AA category. And at least, these guys need to issue, the borrowers need to issue 2 ISINs per year. Sometimes, you have a borrower who has issued 1 ISIN per year and he's done for the year. What do you do market making
with that kind? Yeah.
For issuer. So that's my 2 bits on that.
Yeah.
If I may just add to that, I think sure. I broadly agree with what Manisha said. He brought out the issues. It would be slightly simplistic to say that everything that the market maker wants will come to him in the fees from the issuer, because it looks like on a preliminary basis that the fee requirement from the issuers will be very high. And then the issuer would have concerns that to improve liquidity on my bonds and to reduce the coupon on my future issuance. This is because that is the basic idea, that if you improve the liquidity, then there's greater demand, and then the coupon,
the spreads will come down.
For issuers comes down. But that's somewhat hypothetical. And in future, and if the upfront cost is very high, then the issuer will have problems about this process. So maybe one way to look at this would be that don't look at it tactically in how much cost comes back to the market making institution, on the amount of capital he has committed, on the lines is blocked, on the amount of business is not able to do otherwise because he has blocked these lines. But strategically, is he getting some advantages? So one possibility will be, could we explore giving additional limits to these kind of market makers, that you continue your normal business and you do not lose out there, but this is some incremental business you can do on which you can earn an incremental income, and then hopefully because of that you will not charge that higher fee to the issuer, and the issuer would not lose out in the process.
Yeah, possibly that sounds a more better way for, it's a win-win for both in one sense, the issuer as well as the market maker, and also the investor. So the investor also gains in that process. Otherwise, the investor will also lose out. So all three will gain, and a little bit of market making will be necessary. So all of them, and with a lower fee, the issuer will also be incentivized to help in the market making process. So Shamik, then what changes would you require from the participants with respect to market making?
I think that the participants should be sort of, this is a very philosophical answer because we are going into some unknown territory. They should be incentivized to look at this as a possible future business area and business income area, not to look at the obvious problems and the obvious sort of downsides. Like, for example, we have not discussed it, but the compliance issues would be pretty high, that how do you ensure that you meet the performance targets if there are stiff performance targets? How do you ensure the manpower? How do you ensure that you are putting expensive manpower into this kind of high risk area, and are you getting a return on that? So maybe my wish list would be that participants would look to sort of look at this on a voluntary basis and try to see how it works out, and give it some time and effort, and see that whether it is workable or not, without expecting things to happen in the first 3 or 6 months, because I think that these kind of efforts often don't succeed immediately. They succeed over some period of time, and maybe with some changes in the model.
Yeah,
so
I agree
that would
with
be
you.
my answer.
Yeah, maybe it's more like a service to the market, and then over time build up on that reputation, and then it'll reap its own rewards over a period of time. So yes, you get your things in place, and maybe through whatever experiences that you have, you get a learning curve, and maybe somewhere along the line you will also make the money. So yeah, Manish, anything from your side?
No, Poonam. I think things are still to evolve.
Yeah,
we are all grappling with this entire market making thing, but yeah, hopefully things would be better for the corporate bonds.
Should I start with the question and answers? There is a question for you, Manish. You mentioned, this is from Shifali Sahita. She mentioned that volumes traded as a percent. You said that volumes traded as a percentage of outstanding bonds is not much different from government and corporate bonds. Can you please elaborate how liquidity will be spread across different ratings of corporate bonds?
Sure. So see, first I'll talk about government bonds. So as I said, it's a single borrower, which is Government of India. We have roughly 78 lakh crores of total outstanding across 100 ISINs. Okay, and roughly the volume is 30,000 crore per day. So that works out to about 0.38% of turnover out of the 78 lakh crores. Now, when you look at this versus the corporate bonds, we are talking about 3,500 issuers across 27,000 plus ISINs. Okay, and still we are seeing a volume of about 7,500 to 8,000 crores per day. Now, when you do that math of 8,000 crore of volume a day vis-a-vis 38 lakh crores of total corporate bond outstanding in India, that works out to about 0.22%. Now, given the stark difference between these two issuers categories, one being sovereign, the other being corporate, across rating curves and across number of ISINs, this turnover ratio is not bad, is what I see when I look at it dispassionately. Though I would love to see corporate bonds, get traded much more and volume literally doubling from here. But if I were to just mathematically look at it, it's not bad. Also, publicly available data in terms of, year by year annual volumes, they seem to have grown roughly between 8 to 9% CAGR. So except for the 2008, 18, 19 crisis in the corporate bond segment, that 8 to 9% has been like a consistent growth. So that's my 2 bits to it, that it's a growing thing.
And maybe that he's taken corporate bonds as a whole, not as on the credit rating basis. So that's GSEC 1 and the corporate bonds as a whole as one segment. Yeah. There is another question by Meera Siva who says that what are some examples of good market making frameworks and support organizations globally that India can adopt? Who would like to take this question? I mean, any of you or both of you?
I think I'll just try and say that the dollar bond has the dollar bond market where the issue happens, say, at the start of the month. There is a sort of a market consensus that the ranges to the dollar bonds should act as price stabilization agents for the first 3 or 4 weeks. And in case there is some sellers who want to sell out immediately, they should buy it and find other buyers, so that immediately after the issuance, there should be no rapid drop of prices and rapid increase in yields. But the interesting point here is that this is not a commitment over a longer term. This is not a commitment to provide liquidity at any time of the year. This is a commitment to providing liquidity for, say, the first 3 or 4 weeks post-issuance. So that way, as I mentioned earlier, in India, we seem to be at the cutting edge of how we want the market to evolve. And therefore, we are facing the problems and the challenges first without much guidance from how others have done it. We also understand that market making happens in China. But as with most things in Chinese markets, you don't know that what data you get, how and why it has happened. So it's difficult to have any takeaways from that. But somewhat like our EBP, the electronic bid platform.
Bidding platform, yeah.
In some ways, we are ahead of other markets where it happens on a more informal basis and it does not happen on the screen. So there are several advantages and several upsides to it. Though sometimes an informal process can be a bit more, let's say, it can be customized. It can be customized and it can bring a different level of comfort. But there is also a certain level of comfort that a fixed and an official process has. And the fact, as you mentioned it, Poonam, that we have so many issues in a day, we have so many issues in a year, because everything is happening electronically, we are able to do it faster.
And so transparently also. It is more transparent.
And transparently.
Shamik, because otherwise what happens, only the big players will know, they'll close it out and 2-3 of them will finish it off, right? So the other people just get shut out of this. So this becomes transparent. So to that extent, it's much better. I mean, this is much better than what it used to be so many years back in India and even abroad. And I don't think anybody has a EBP platform, if I'm not mistaken, because there it's just a club, right? They just
It is coming up, Poonam. It is coming up because, just to give a small example, again, thanks to COVID, people now feel that there is no need to do road shows. You can do everything virtually. And if you're doing everything virtually, why don't you sell your bond virtually also?
Virtually also, yes.
Screen.
Yes. So I think
So
COVID has been the major, major, this thing in getting people to do it more on the screen. But I mean, when I was abroad, I mean, what it used to be as same as what we were, 15, 20 years back, that, it was 2-3 people's club and they used to close out issues, and that's how. And even there was no screen-based trading. They were quite, opaque from that point of view. So I think we are far more transparent. I mean,
yes.
I mean, I maybe technologically also, and settlement-wise also, we are far better. Maybe now, as you said, because of COVID, things would have changed a little.
No, if I can just interject over here, sometimes when we talk about our markets and we possibly don't realize we may be a emerging economy, but as far as markets go, we are as good as developed markets and sometimes better.
Yeah, we are much better.
Recently in the US fixed income dealers and primary dealers were complaining about why trades should come up within 15 minutes on this sort of screen ticker, because they would not be able to trade. And in India, both in the corporate bonds with SEBI and in the GSEC markets with RBI, trades come up in the next 5-10 minutes as soon as they are done.
Yes.
So we are very developed.
I remember even way back in 2008-9 and all, when we had an NDS home which used to work, and settlements were done. They were done. I mean, there I was in London, and there were times when there used to be always failed trades. Every day you will find so many failed trades. Trades were not settled, and it used to be T+3. Okay, our corporate bond is T+1. So even those many days back, we were far better. I don't know how things would be now, but I found it shocking, those days. But maybe those markets are old and they continue that way, while we maybe our regulators pushed us, to be better on technology. So we were far ahead. That's what even I found. There's another question from Meera Siva again. What are some India-centric issues that may make this problem more difficult than other markets? I don't think so.
No, I think maybe I would try a guess over here. I think one India-centric problem is that there is too much of name selling in our market. So as a market, undoubtedly, I agree that the government ownership helps some quasi sovereigns get some
better pricing,
better pricing and better appeal. But somewhere I think that if you leave out the quasi sovereigns and the PSUs, you don't have a proper appreciation of a good credit. We just look at the ownership and try to say whether we like it or not. So ultimately, till we go to a stage where we have a better appreciation of credit, how does the liquidity come in? And then to just flip it around and look at it from the other side, why is there this kind of name preference? Because there are still doubts about the quality of accounting, the quality of corporate governance, the first generation companies, the quality of ratings. And the good news is that I think we have had so many financial scams recently. The good news is that regulations are becoming tougher, audit is becoming tougher, regulators are becoming tougher, ratings are becoming stringent. So possibly we have passed the worst. And going ahead, if things continue to improve, we would have a proper appreciation of credits, which will lead to a better liquidity across credits.
Yeah, possibly. So that Samudra Manthan is over now. So all the poison is out of the system, kind of. So Manish, is the approach on market making by regulators a knee-jerk reaction to bond market crisis in early 2020? If so, in a crisis, the risk for the market maker is more, and the bid offer spread will be much beyond the usual best bid or best offer rates, and may not want to undertake that risk.
So, to start with, I think over here SEBI is trying to put the burden of creating this entire market making thing on the issuer. Now, if I were an issuer to start with, I would say, I would go and access the term loan market. I would not probably want to pay that extra price for, to the arranger or the market maker for doing the market making, which will help me get a better price. So that's my first thought. Obviously, the journey has to start, no doubt about that. But at the same time, we'll have to dial down to the rating part of it. That, okay, maybe if not all the way, maybe AAA, AA plus to some extent we start. As I said earlier, maybe we concentrate on the top 200 to 400 issuers from that perspective, so that both market making can start. At the same time, issuers are not too feeling burdened. So that would be my thoughts about that.
There's another question. How would market makers' role change with huge digital adoption? Will there be software and a predictive algorithm that can do the job? This question is by Sachit Gaudi. Who would like to take this question, or both of you?
I will try. I will try it because we are an active primary dealer, and we still don't find algo trading working yet in GSECs, which have high liquidity. Maybe it's early days for us. It's early days for our markets. Maybe you need somebody to come in outside the regular markets and find ways to make it work, because sometimes the largest of market participants find it the most difficult to do new things. So you don't know from where this kind of thing will come up. But if you look at corporate bonds are so unusual. They have so many ISINs, so many issuers, so many credit perceptions. I think the right question would be that when do we expect fintech and digital to make its mark in GSEC markets?
Right.
And also maybe to rephrase the question, we talked about how screen trading is increasing in overseas markets. How can fintech increase the ability of one investor to reach out to another investor, even without a market maker? And there's a buyer online, there's a seller online. How can fintech get them to match each other and create liquidity? That would be, I think, the really important role of fintech.
I agree. Yes, that could be one role. So it actually takes out the role of a market maker, right?
Yeah. Yeah.
There is a question by, I think, Vijendra. He says, don't you think a backstop and corporate bond repo will solve a big problem for intermittent liquidity gaps?
So
yes, Manish.
Yeah. So see, in terms of corporate bond repo, I mean, volumes have just started picking up. No doubt they have helped in creating a liquidity. But, when it comes to mark to market or in a rising interest rate scenario, liquidity is not so much of a challenge as much as the actual loss. So I'm not sure if corporate bond repo can help to that extent to the market maker. But yes, it definitely helps you create,
liquidity
for
funding
for the time being. Unlike, equity markets, which are volatile in India, we typically see that the cycles of interest rates are simply one-sided. Today everybody is talking about interest rate rise over the next 2 years. So it's not that we are going to have a choppy market to that extent, which will, help the repo. If I do a, say, 1 year repo or a 6-month repo, it might still help me.
I agree. There's another question by Meera Siva. I think this is the last one I'll take since we are running out of time. Does the IBC in any way change the risk perception in the market? I think maybe she means that corporate bonds will become slightly less riskier or something on those lines because of the IBC coming in.
So see, IBC has been a welcome change, from the market participants. No doubt about that. We've seen a lot of solved cases. But when we talk about market making per se, we are talking about, again, the top, say 100, 200 names and top AAA, AA plus issuers, getting the benefit of this kind of a market making. I don't see this going down the rating curve very soon, where IBC might play a role, is my view.
And I think even for NBFCs, IBC is not really applicable, right? Is that so? As far as I thought,
it can be applicable, Poonam. There has been it has been allowed that the Reserve Bank can refer companies to IBC or NCLAT. But just to add to what Manish said, I think I fully agree that
we've not yet gone down that curve.
IBC does not help liquid credits,
right?
But illiquid credits, say A plus and below, which investors hold to maturity, if they have a view that the security is enforceable and the security is good, they should be able to take greater interest. Now, the problem we are facing is that if we had expectation that the IBC process would get over in 1 year, and it's happening over 2 or 2.5 years,
and it's
the investor is losing out on the time value of his money on recovering it. So if he can bring down the period of that recovery process,
resolution becomes faster, then like people will also look to go down the credit curve, and then market making will also happen more there. Second, there's a last question which I'll take now. Hitesh Tekwani says, do institutions prefer RFQ platform, or would they still prefer to deal in the OTC markets?
Based on the interactions that I have had with market participants, it is clearly that people like the digital platform, no doubt about that. But at the same time, OTC market has its own benefits in terms of execution of bulk trades, which RFQ as a platform might not be beneficial for. The other thing is, now there is a two-way opinion. A lot of people say that on the RFQ, I would want to be anonymous rather than being visible, which is to some extent possible over the OTC market. Even the RFQ market gives you that option. But let's assume if the RFQ market, like the NDS home, becomes totally anonymous, then you're taking the risk exactly on the credit or the interest rates, not knowing that who's selling or who's buying.
Shamik, anything from your side on this?
I think both need to coexist and sort of compete with each other, and we have to see how it evolves over time.
So I think we could close down because it's 7:40. We've already exceeded by 10 minutes. Thank you, both of you, Manish and Shamik, for such an insightful discussion that we've had. I really enjoyed discussing this with you and got so much more insights into how market making can evolve and what are the problems that we have been facing over this last few decades that we've seen the markets. Things have become better over time, but yes, we need to evolve much more, and I'm sure we will. So thank you, both of you, Manish and Shamik, for being here and on the panel. And I'm sure our listeners and would have also really enjoyed this, and have a good evening and a good weekend as well.
Thank you, Poonam, and thanks. You asked us the right questions, and we tried to answer them to the best of our abilities.
I know it's still an evolving situation, so let's hope that we have a better experience going forward for all of us, the issuers, investors, and the market makers. So thank you, and have a nice weekend.
Thank you. Thank you.
And thanks to the CFA organizers and the society as well for putting up this event. Yogesh, you're on mute.
Thank you, Dr. Poonam Tandon, for that wonderful session on market making in bonds. Thank you so much. Thanks for taking time on a weekend, and have a great weekend.
Thank you so much. Thanks for inviting me. It was a wonderful time together. Thanks.
Thank you.